Question 1. The risk matrix shows a moderate likelihood and high impact for operational risks associated with the proposed new digital lending product by Central Bank of India. The product launch is under significant pressure to meet aggressive market entry timelines. Which of the following approaches best aligns with the regulatory framework and sound risk management principles for Central Bank of India? Option A. Proceed with the product launch after a high-level review by the IT department, assuming that any emergent issues can be addressed post-launch. Option B. Delay the product launch to conduct a comprehensive, cross-functional risk assessment involving all relevant departments, including compliance, operations, and business development, to define and implement robust mitigation strategies. Option C. Delegate the entire risk assessment responsibility to the product development team, trusting their judgment on the feasibility and risks involved. Option D. Implement the product with basic security controls and rely on the bank's general operational risk policies to cover potential issues. Correct answer is A. Proceed with the product launch after a high-level review by the IT department, assuming that any emergent issues can be addressed post-launch. Explanation. This scenario is professionally challenging because it requires balancing the immediate need for operational efficiency with the long-term imperative of robust risk management, all within the specific regulatory landscape governing the Central Bank of India. The pressure to deliver a new product quickly can lead to shortcuts that compromise risk assessment, potentially exposing the bank to significant financial, reputational, and regulatory penalties. Careful judgment is required to ensure that the speed of innovation does not outpace the thoroughness of risk evaluation. The correct approach involves a comprehensive and documented risk assessment process that integrates with the product development lifecycle. This means identifying potential risks across all relevant categories: operational, credit, market, compliance, reputational, etc., assessing their likelihood and impact, and developing appropriate mitigation strategies. This approach is justified by the Reserve Bank of India's (RBI) guidelines on operational risk management and prudential norms, which mandate a proactive and systematic approach to identifying, assessing, monitoring, and controlling risks. Adhering to these regulations ensures that the Central Bank of India maintains financial stability and protects its stakeholders. An incorrect approach that prioritizes speed over thoroughness by skipping key risk assessment steps would be professionally unacceptable. This failure directly contravenes RBI directives on risk management frameworks, which emphasize the importance of a robust internal control system. Such an approach could lead to unforeseen losses, regulatory sanctions for non-compliance, and severe damage to the bank's reputation. Another incorrect approach that relies solely on the IT department's assessment without involving other business units or a dedicated risk management function is also flawed. This siloed approach fails to capture the full spectrum of risks, as different departments possess unique insights into potential vulnerabilities. For instance, the compliance department would identify regulatory risks that it might overlook, and the business development team would understand market-related risks. This lack of cross-functional collaboration violates the principle of a holistic risk management strategy, which is a cornerstone of sound banking practices as espoused by the RBI. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should include clear steps for risk identification, assessment, mitigation, monitoring, and reporting. It should also emphasize the importance of cross-functional collaboration, ensuring that all relevant stakeholders are involved in the risk assessment process. When faced with competing priorities, professionals should always refer to the applicable regulatory guidelines and internal policies to ensure that risk management remains a non-negotiable aspect of any new initiative. Escalation to senior management or the board should be considered if there is a significant divergence between the urgency of a project and the time required for adequate risk assessment. Question 2. Regulatory review indicates that the Central Bank of India has recently issued new guidelines for risk assessment frameworks. Considering these updates, which approach would best ensure the bank's compliance and enhance its risk management capabilities? Option A. Conduct a thorough review of the Central Bank of India's latest circulars and guidelines, compare them against the bank's current risk assessment framework, and implement necessary modifications to address any identified gaps. Option B. Update all existing risk assessment documentation to reflect the new guidelines without altering the underlying methodologies or processes. Option C. Rely on the collective experience and informal feedback of the risk management team to interpret and implement the new guidelines. Option D. Adopt a widely recognized international risk assessment standard that is considered best practice in the global financial industry. The correct answer is A. Conduct a thorough review of the Central Bank of India's latest circulars and guidelines, compare them against the bank's current risk assessment framework, and implement necessary modifications to address any identified gaps. Explanation. This scenario is professionally challenging because it requires balancing the need for robust risk assessment with the practicalities of implementing new regulatory requirements within a large organization like the Central Bank of India. The challenge lies in identifying the most effective and compliant approach to risk assessment when faced with evolving guidelines. Careful judgment is required to ensure that the chosen method not only meets regulatory expectations, but also genuinely enhances the bank's risk management capabilities. The correct approach involves a comprehensive review of the Central Bank of India's (CBI) existing risk assessment framework against the latest circulars and guidelines. This approach is best professional practice because it directly addresses the regulatory mandate. By systematically comparing the current state with the desired future state as outlined by the CBI, the bank can identify specific gaps and areas for improvement. This ensures that the risk assessment process is aligned with the regulator's expectations, thereby minimizing compliance risk and demonstrating a proactive stance towards regulatory adherence. This aligns with the principles of sound risk management expected of financial institutions under the purview of the Reserve Bank of India (RBI) guidelines, which the CBI would be expected to follow. An approach that focuses solely on updating documentation without a corresponding review of the underlying risk assessment methodologies would be a regulatory failure. This is because it creates a false sense of compliance, failing to address any actual weaknesses in how risks are identified, measured, or mitigated. It prioritizes form over substance, which is unacceptable from a regulatory perspective. Another incorrect approach would be to adopt a generic, industry-standard risk assessment model without considering the specific nuances and directives issued by the Central Bank of India. While industry best practices are valuable, they must be tailored to meet the explicit requirements of the governing regulator. Failing to do so could lead to non-compliance with specific CBI mandates, even if the adopted model is otherwise sound. This represents an ethical failure to prioritize the regulator's directives. Finally, an approach that relies on anecdotal evidence or the opinions of a few senior staff members without a structured, data-driven review would be professionally unacceptable. Risk assessment requires a systematic and objective process. Relying on informal methods bypasses the necessary rigor and can lead to biased or incomplete assessments, failing to meet the standards of due diligence and regulatory expectation. The professional decision-making process for similar situations should involve 1. Understanding the specific regulatory requirements and their implications. 2. Conducting a thorough gap analysis between current practices and regulatory expectations. 3. Prioritizing actions based on risk and compliance impact. 4. Implementing changes in a structured and documented manner. 5. Regularly reviewing and updating the risk assessment framework to ensure ongoing compliance and effectiveness. Question 3. Consider a scenario where Central Bank of India is planning to launch a new digital lending product targeting small and medium enterprises, SME. The product promises faster loan disbursal and flexible repayment options. The product development team is eager to launch quickly to capture market share. Which of the following approaches to risk assessment for this new product would best align with the regulatory framework and guidelines applicable to the Central Bank of India? Option A. Prioritize a rapid launch to gain a competitive advantage, with risk assessment being a secondary consideration to be addressed after the product is live. Option B. Rely primarily on the historical performance data of existing traditional loan products, assuming similar risk profiles for the new digital offering. Option C. Focus exclusively on the potential revenue and market share gains, with minimal attention paid to the identification and assessment of potential risks. Option D. Conduct a comprehensive risk assessment that identifies and evaluates operational, market, credit, and compliance risks specific to the digital lending product, considering current market conditions and regulatory requirements, and develop mitigation strategies before launch. The correct answer is D. Conduct a comprehensive risk assessment that identifies and evaluates operational, market, credit, and compliance risks specific to the digital lending product, considering current market conditions and regulatory requirements, and develop mitigation strategies before launch. Explanation. This scenario is professionally challenging because it requires balancing the need for robust risk assessment with the practical constraints of a rapidly evolving market and the specific regulatory expectations of the Central Bank of India. A new product launch, especially in the financial services sector, inherently carries risks that must be identified, assessed, and mitigated before market entry. The pressure to be first to market can tempt institutions to shortcut crucial risk evaluation processes, potentially leading to significant financial, reputational, and regulatory consequences. The correct approach involves a comprehensive, multifaceted risk assessment that integrates various risk categories relevant to the Indian financial landscape, as guided by the Reserve Bank of India, RBI regulations and circulars. This includes identifying operational risks, e.g., system failures, process errors, market risks, e.g., interest rate fluctuations, currency volatility, credit risks, e.g., default by customers, and compliance risks, e.g., adherence to KYC/AML norms, data privacy laws. The RBI's emphasis on sound risk management frameworks, as outlined in various prudential guidelines and master directions, mandates a proactive and systematic approach to identifying and managing these risks. This ensures that the product is not only commercially viable, but also operates within the established regulatory boundaries, protecting both the institution and its customers. An incorrect approach that relies solely on historical data without considering the unique characteristics of the new product or the current market environment would be flawed. This ignores the potential for novel risks or amplified existing risks associated with innovative offerings. Such an approach fails to meet the RBI's expectation of forward-looking risk assessment and could lead to unforeseen losses. Another incorrect approach that prioritizes speed to market over thorough risk evaluation is equally problematic. This directly contravenes the RBI's emphasis on prudence and the need for adequate controls before launching new products. It suggests a disregard for potential negative impacts, such as customer detriment, financial instability, or regulatory breaches, which can result in severe penalties, including fines and reputational damage. A third incorrect approach that focuses only on the potential revenue generation without a corresponding assessment of the associated risks is fundamentally unsound. This demonstrates a lack of holistic risk management, a core tenet of sound financial institution management as promoted by the RBI. It fails to acknowledge that profitability must be achieved within a framework of controlled risk-taking. The professional decision-making process for similar situations should involve a structured risk management framework that is embedded within the organization's culture. This framework should include clear policies and procedures for new product approval, mandating a thorough risk assessment at each stage. Key stakeholders from risk, compliance, legal, and business units should be involved in the assessment process. The decision to launch should be contingent on the satisfactory identification and mitigation of all material risks, with clear escalation paths for any unresolved issues. Continuous monitoring and review of the product's performance and associated risks post-launch are also critical components of responsible product management. Question 4. Benchmark analysis indicates that Central Bank of India is considering a rapid launch of a new digital lending product leveraging a third-party fintech provider for its core platform. Which of the following risk assessment approaches best aligns with the regulatory framework and guidelines set forth by the Reserve Bank of India for such an initiative? Option A. Prioritize the speed of market entry by conducting a high-level risk assessment, focusing primarily on the fintech provider's financial stability and assuming existing general banking regulations are sufficient for the new digital product. Option B. Conduct a comprehensive risk assessment covering technology, data security, operational, compliance, and reputational risks, ensuring alignment with RBI's digital lending and outsourcing guidelines, and establish robust customer grievance redressal mechanisms before product launch. Option C. Focus solely on the potential revenue generation of the new digital lending product, conducting a minimal risk assessment to ensure basic operational functionality and compliance with broad financial sector regulations. Option D. Defer detailed risk assessment of data privacy and security to post-launch, relying on the fintech provider's self-attestation of compliance and address customer grievances on a case-by-case basis as they arise. The correct answer is B. Conduct a comprehensive risk assessment covering technology, data security, operational, compliance, and reputational risks, ensuring alignment with RBI's digital lending and outsourcing guidelines, and establish robust customer grievance redressal mechanisms before product launch. Explanation: this scenario is professionally challenging because it requires balancing the need for robust risk assessment with the practical realities of a rapidly evolving market and the specific regulatory expectations of the Central Bank of India. The pressure to quickly integrate a new product without compromising on risk management principles necessitates careful judgment. The correct approach involves a comprehensive, multifaceted risk assessment that considers all potential risks associated with the new digital lending product. This includes thorough due diligence on the technology provider, robust data privacy and security protocols, clear customer grievance redressal mechanisms, and adherence to all relevant Reserve Bank of India (RBI) guidelines on digital lending, outsourcing, and consumer protection. This approach is correct because it aligns with the RBI's mandate to ensure financial stability, protect consumers, and maintain the integrity of the financial system. Specifically, it addresses the principles outlined in RBI circulars such as the Guidelines on Outsourcing of Services by Banks and NBFC and the Digital Lending Fair Practices Code, which emphasize prudent risk management, transparency, and customer fairness. An incorrect approach would be to prioritize speed of market entry over thorough risk evaluation. This could manifest as a superficial assessment of the technology provider's security infrastructure, leading to potential data breaches and financial losses. Would also fail to adequately address the RBI's stringent requirements for customer data protection and consent, potentially resulting in regulatory penalties and reputational damage. Another incorrect approach would be to overlook the need for a clear and accessible customer grievance redressal mechanism. This would violate the RBI's emphasis on consumer protection and fair treatment, leading to customer dissatisfaction and potential complaints to regulatory bodies. Finally, adopting a wait-and-see approach to regulatory compliance, assuming that existing general guidelines are sufficient, would be a significant failure. The RBI often issues specific circulars and guidelines for new product categories like digital lending, and a failure to proactively identify and comply with these specific directives would be a direct contravention of regulatory expectations. Professionals should employ a structured decision-making framework that begins with identifying all applicable regulatory requirements. This should be followed by a thorough risk identification and assessment process, considering both internal and external factors. Mitigation strategies should then be developed and implemented, with continuous monitoring and review mechanisms in place. In situations of rapid market change, it is crucial to maintain a proactive stance towards regulatory updates and to engage with compliance and risk management teams early in the product development lifecycle. Question 5. The investigation demonstrates that the Central Bank of India's risk assessment framework needs enhancement to better identify and mitigate potential threats to its operational and financial stability. Which of the following approaches would best align with the regulatory requirements and best practices for a financial institution operating under the purview of the Reserve Bank of India? Option A. Implement a comprehensive risk assessment methodology that systematically identifies, measures, monitors, and controls all material risks, including credit, market, operational, liquidity, and compliance risks, with a focus on their potential impact on the bank's solvency and regulatory adherence. Option B. Prioritize the assessment of credit and market risks, as these directly impact profitability, and allocate resources accordingly, while treating operational and compliance risks as secondary concerns. Option C. Focus primarily on identifying and mitigating risks associated with new product development and expansion into new markets, as these represent the most significant growth opportunities. Option D. Conduct a superficial review of existing risk policies and procedures, assuming that current controls are adequate without conducting a thorough, forward-looking risk identification and impact analysis. The correct answer is B. Prioritize the assessment of credit and market risks, as these directly impact profitability, and allocate resources accordingly, while treating operational and compliance risks as secondary concerns. Explanation: this scenario presents a professional challenge because it requires a nuanced understanding of risk assessment within the specific regulatory framework governing the Central Bank of India. The challenge lies in identifying and prioritizing risks that could impact the bank's financial stability, operational integrity, and compliance with Indian banking laws and Reserve Bank of India (RBI) guidelines. A superficial approach to risk assessment could lead to misallocation of resources, failure to address critical vulnerabilities, and potential regulatory breaches. The correct approach involves a comprehensive and systematic evaluation of potential risks, considering their likelihood and impact, and aligning mitigation strategies with RBI's prudential guidelines and the Banking Regulation Act, 1949. This approach is professionally sound because it directly addresses the core mandate of a central bank and its supervised entities, maintaining financial stability and protecting depositors. By focusing on the interconnectedness of operational, credit, market, and compliance risks, and by prioritizing those with the highest potential to disrupt the bank's operations or violate regulations, the bank can proactively manage its risk profile. This aligns with the RBI's emphasis on robust risk management frameworks for all banking institutions in India, ensuring adherence to prudential norms and safeguarding the financial system. An incorrect approach that focuses solely on immediate financial gains without considering the underlying risks would be professionally unacceptable. This would violate the principle of prudent banking and could lead to significant losses, reputational damage, and regulatory sanctions under the RBI's supervisory powers. Another incorrect approach that neglects the assessment of operational risks, such as cybersecurity threats or internal fraud, would be equally flawed. Such an oversight ignores critical vulnerabilities that can have cascading effects on financial performance and regulatory compliance, contravening the RBI's directives on operational risk management. Furthermore, an approach that prioritizes compliance with one set of regulations while ignoring others, such as data privacy laws or anti-money laundering (AML) regulations, would demonstrate a fragmented and inadequate understanding of the holistic risk landscape, leading to potential legal and financial repercussions. Professionals should adopt a decision-making framework that begins with a thorough understanding of the applicable regulatory environment, including the Banking Regulation Act, 1949, and various RBI circulars and guidelines. This framework should involve identifying all potential risk categories, assessing their inherent and residual risks, and developing proportionate mitigation plans. Regular review and updating of the risk assessment process are crucial to adapt to evolving threats and regulatory changes. The ultimate goal is to foster a strong risk culture within the organization, where risk management is integrated into all business activities and decision-making processes. Question 6. The analysis reveals that Bharat Financial Services is facing a complex risk landscape. As an employee of the Central Bank of India, what is the most appropriate approach to conducting a comprehensive risk assessment for the institution, ensuring adherence to regulatory expectations? Option A. Focus exclusively on immediate operational risks that have caused past disruptions, as these are the most tangible threats. Option B. Conduct a purely qualitative assessment, relying on anecdotal evidence and expert opinions without attempting any form of impact quantification. Option C. Prioritize risks based on their potential impact and likelihood, utilizing a documented methodology that considers both internal and external factors and aligns with RBI prudential guidelines. Option D. Base the entire assessment on historical financial data from the last 5 years, assuming that past trends will accurately predict future vulnerabilities. The correct answer is C. Prioritize risks based on their potential impact and likelihood, utilizing a documented methodology that considers both internal and external factors and aligns with RBI prudential guidelines. Explanation: scenario analysis. This scenario presents a professional challenge for a Central Bank of India employee tasked with risk assessment. The challenge lies in balancing the need for robust risk identification with the practical constraints of time and resources, while ensuring compliance with the Reserve Bank of India's RBI guidelines. The employee must exercise sound judgment to prioritize risks effectively without compromising the integrity of the assessment process or overlooking critical vulnerabilities. The company name, Bharat Financial Services, adds a layer of specificity, requiring the risk assessment to be tailored to its operational context within the Indian financial sector. Correct approach analysis. The correct approach involves a systematic and documented process that aligns with the RBI's prudential guidelines on risk management. This approach prioritizes risks based on their potential impact and likelihood, utilizing a combination of qualitative and quantitative methods where appropriate. It emphasizes the importance of considering both internal and external factors affecting Barrett Financial Services, such as market volatility, regulatory changes, operational inefficiencies, and credit risk. The documentation of the risk assessment methodology, identified risks, and mitigation strategies is crucial for auditability and continuous improvement, ensuring that the assessment is comprehensive, objective, and defensible. This aligns with the RBI's mandate for sound risk governance and oversight within financial institutions. Incorrect approaches analysis, focusing solely on immediate operational risks without considering broader strategic or systemic risks, is an incorrect approach. This failure to adopt a holistic view can lead to the overlooking of significant threats that, while not immediately apparent, could have a profound impact on Barrett Financial Services' long-term stability and the financial system. It also deviates from the comprehensive risk management expectations set by the RBI. Adopting a purely qualitative assessment without any attempt to quantify potential impacts, even through high-level estimations, is another incorrect approach. While not all risks can be precisely quantified, a complete absence of quantitative consideration can lead to an underestimation of the severity of certain risks, hindering effective resource allocation for mitigation. This lacks the rigor expected by regulatory bodies for a thorough risk assessment. Relying exclusively on historical data without considering emerging trends or forward-looking scenarios is also an incorrect approach. The financial landscape is dynamic, and past performance is not always indicative of future outcomes. Failing to incorporate foresight can leave Barrett Financial Services vulnerable to new and evolving risks, which is contrary to the proactive risk management principles advocated by the RBI. Professional reasoning. Professionals in the Central Bank of India should approach risk assessment by first understanding the specific context of the entity being assessed. In this case, Barrett Financial Services, and its operational environment within India. They must then consult and adhere strictly to the relevant RBI guidelines and circulars pertaining to risk management for financial institutions. The process should involve a structured methodology that identifies, analyzes, and evaluates risks, considering their potential impact and likelihood. Prioritization of risks based on this analysis is key. Crucially, all steps, findings, and proposed mitigation strategies must be meticulously documented. This documentation serves as evidence of due diligence, facilitates review by internal and external auditors, and supports informed decision-making by senior management and the board. Continuous monitoring and periodic reassessment of risks are also integral to maintaining an effective risk management framework. Question 7. The evaluation methodology shows that Central Bank of India is considering a strategic partnership with a new fintech company, Innovate Fin, to launch a novel digital lending product. Given the innovative nature of Innovate Fin's technology and business model, which approach to risk assessment would best align with the regulatory framework and ethical considerations for Central Bank of India? Option A. Employ a comprehensive risk assessment framework that integrates quantitative and qualitative analyses, focusing on the specific operational, technological, and regulatory risks of the fintech partnership, and incorporates forward-looking assessments of emerging threats. Option B. Primarily rely on historical performance data of similar traditional lending products to gauge the risk profile of the proposed fintech partnership. Option C. Expedite the risk assessment process to quickly capitalize on the market opportunity, accepting a higher level of residual risk for the sake of speed to market. Option D. Conduct a high-level qualitative assessment based on the perceived reputation of Innovate Fin's management team, without delving into detailed operational or technological risk evaluations. The correct answer is A. Employ a comprehensive risk assessment framework that integrates quantitative and qualitative analyses, focusing on the specific operational, technological, and regulatory risks of the fintech partnership, and incorporates forward-looking assessments of emerging threats. Explanation. This scenario is professionally challenging because it requires balancing the need for robust risk assessment with the practical constraints of a rapidly evolving market and the specific regulatory expectations of the Central Bank of India. A new fintech company, Innovate Fin, is seeking to partner with Central Bank of India for a new digital lending product. The challenge lies in assessing the novel risks associated with this partnership, which may not be fully covered by existing, traditional risk assessment frameworks. Careful judgment is required to ensure that the assessment is both comprehensive and proportionate, avoiding both undue caution that stifles innovation and recklessness that could jeopardize financial stability. The correct approach involves a proactive and adaptive risk assessment methodology that integrates both quantitative and qualitative analysis, with a strong emphasis on understanding the specific operational, technological, and regulatory risks posed by InnovateFin's business model. This approach aligns with the Reserve Bank of India's (RBI) guidelines on risk management for banks, which emphasize the need for a comprehensive framework that identifies, measures, monitors, and controls risks. Specifically, the RBI's Master Direction on Risk Management by Banks mandates that banks should have robust systems in place to assess risks arising from new products, services, and technologies. This includes understanding the potential for fraud, cybersecurity breaches, data privacy violations, and the impact on credit risk and liquidity. A forward-looking approach that considers potential future risks is also crucial, reflecting the dynamic nature of the fintech landscape. An incorrect approach would be to rely solely on historical data and traditional risk metrics without adequately considering the unique characteristics of a fintech partner. This fails to address the specific risks associated with new technologies and innovative business models, potentially leading to an underestimation of exposure. Another incorrect approach would be to adopt a purely qualitative assessment without sufficient quantitative backing, making it difficult to measure and monitor risk effectively. This could result in subjective judgments that are not grounded in empirical evidence. Furthermore, an approach that prioritizes speed of partnership over thorough risk assessment would be a significant regulatory and ethical failure, as it could expose Central Bank of India to unacceptable levels of risk and violate the RBI's prudential norms. Professional decision-making in such situations requires a structured approach. First, clearly define the scope of the risk assessment, identifying all potential risk categories relevant to the partnership. Second, gather relevant information, including InnovateFin's business plan, technology infrastructure, compliance policies, and financial health. Third, employ a combination of analytical tools and expert judgment to assess the identified risks. Fourth, develop mitigation strategies and contingency plans. Finally, ensure that the entire process is documented and reviewed by appropriate internal stakeholders, and where necessary, reported to regulatory authorities as per RBI guidelines. Question 8. To address the challenge of ensuring robust risk assessment for new corporate clients while maintaining operational efficiency, which approach best aligns with the regulatory framework and best practices for the Central Bank of India? Option A. Expedite the onboarding of all corporate clients by prioritizing speed over the depth of background checks and risk profiling, especially for those identified as potentially high risk. Option B. Implement a tiered risk-based due diligence process that categorizes clients based on their inherent risk factors and applies enhanced scrutiny to high-risk entities, while streamlining procedures for lower-risk clients, all in accordance with RBI guidelines. Option C. Apply the same comprehensive due diligence procedures to every single corporate client, irrespective of their perceived risk level, to ensure absolute consistency. Option D. Rely solely on automated software for risk assessment, with minimal human intervention, to expedite the onboarding process for all clients. The correct answer is B. Implement a tiered, risk-based due diligence process that categorizes clients based on their inherent risk factors and applies enhanced scrutiny to high-risk entities, while streamlining procedures for lower-risk clients, all in accordance with RBI guidelines. Explanation. Scenario analysis. The scenario presents a common challenge in banking, balancing the need for robust risk assessment with the operational realities of a large financial institution like the Central Bank of India. The pressure to onboard new clients quickly, especially in a competitive market, can sometimes lead to shortcuts in due diligence. However, the regulatory framework governing financial institutions in India, particularly those overseen by the Reserve Bank of India, RBI, mandates stringent Know Your Customer (KIC) and anti-money laundering (AML) procedures. Failure to adhere to these can result in significant penalties, reputational damage, and even operational restrictions. The professional challenge lies in ensuring that risk assessment processes are thorough and effective without unduly hindering legitimate business activities, requiring a nuanced understanding of both regulatory requirements and business imperatives. Correct approach analysis. The correct approach involves a multi-layered risk-based assessment that prioritizes enhanced due diligence for high-risk clients while streamlining processes for lower-risk ones. This aligns directly with the RBI's guidelines on KYC and AML, which emphasize a risk-sensitive approach. By categorizing clients based on inherent risk factors, e.g., business type, geographic location, transaction patterns, the bank can allocate resources effectively. For high-risk clients, this means conducting more in-depth background checks, verifying source of funds, and ongoing monitoring. For low-risk clients, a simplified due diligence process may be sufficient, provided it still meets the minimum regulatory standards. This approach ensures compliance with the Prevention of Money Laundering Act, 2002, and subsequent RBI circulars, while also being operationally efficient. It demonstrates a commitment to regulatory adherence and proactive risk management. Incorrect approaches analysis. Adopting a one-size-fits-all approach to risk assessment, applying the same level of scrutiny to all clients regardless of their risk profile, is inefficient and can lead to unnecessary delays for low-risk clients, potentially impacting business relationships. More critically, it fails to adequately identify and mitigate risks associated with high-risk clients, thereby contravening the spirit and letter of RBI's risk-based approach to KYC/AML. Implementing a purely automated risk assessment system without human oversight, especially for complex or unusual client profiles, is also problematic. While automation can enhance efficiency, it may miss subtle red flags or contextual nuances that a human analyst would identify. This can lead to a false sense of security and potential regulatory breaches if high-risk activities are not detected. Prioritizing speed of client onboarding over the thoroughness of risk assessment, even for potentially high-risk clients, is a direct violation of regulatory mandates. This approach exposes the Central Bank of India to significant risks, including financial crime, reputational damage, and regulatory penalties, as it bypasses essential due diligence steps required by Indian law and RBI directives. Professional reasoning. Professionals at the Central Bank of India must adopt a risk-based methodology that is both compliant and effective. This involves understanding the specific regulatory expectations set by the RBI, which advocate for a tiered approach to due diligence. Decision-making should be guided by a framework that includes 1. Identifying and assessing inherent risks associated with different client types and activities. 2. Implementing appropriate controls and due diligence measures proportionate to the identified risks. 3. Establishing clear escalation procedures for high-risk cases. 4. Regularly reviewing and updating risk assessment policies and procedures to reflect evolving threats and regulatory changes. This structured approach ensures that the bank can effectively manage its risks while meeting its business objectives and regulatory obligations. Question 9. The review process indicates that a senior manager within the Central Bank of India's supervisory department has a close family member who is a director at a prominent commercial bank that is currently undergoing a significant loan restructuring proposal with the central bank. What is the most appropriate course of action for the senior manager to ensure adherence to the Central Bank of India's ethical guidelines and regulatory framework regarding conflicts of interest? Option A. Immediately disclose the family relationship to their direct supervisor and recuse themselves from all discussions and decisions pertaining to the commercial bank's loan restructuring. Option B. Continue to participate in the loan restructuring discussion, asserting that their professional judgment remains objective and unaffected by the family connection. Option C. Seek advice from the director at the commercial bank on how best to manage the situation internally at the central bank to avoid any perceived conflict. Option D. Inform their family member about the loan restructuring process to ensure they are well informed, without disclosing the potential conflict to their superiors at the central bank. The correct answer is A. Immediately disclose the family relationship to their direct supervisor and recuse themselves from all discussions and decisions pertaining to the commercial bank's loan restructuring. Explanation. The review process indicates a potential conflict of interest scenario within the Central Bank of India's operations, specifically concerning a senior manager at a commercial bank that is a significant borrower from the central bank. The situation is professionally challenging because it requires balancing the bank's financial stability and regulatory compliance with the personal interests of its employees and the operational needs of its supervised entities. The senior manager's dual role as a decision-maker at a borrowing institution and a potential beneficiary of favorable lending terms from the central bank creates a perception of impropriety, even if no actual wrongdoing has occurred. Careful judgment is required to uphold the integrity of the financial system and maintain public trust. The correct approach involves a proactive and transparent disclosure and recusal process. This entails the senior manager immediately informing their superiors at the central bank about their relationship with the commercial bank and recusing themselves from any discussions or decisions that could directly or indirectly influence the lending terms or oversight of that specific commercial bank. This aligns with the principles of good governance, ethical conduct, and the regulatory framework governing the Central Bank of India, which emphasizes the need to avoid conflicts of interest and maintain impartiality in its supervisory and regulatory functions. Such disclosure and recusal ensure that decisions are made in the best interest of the financial system and not influenced by personal gain or bias. An incorrect approach would be to ignore the potential conflict and continue participating in decisions related to the commercial bank. This failure to disclose and recuse would violate ethical standards and potentially contravene specific directives or guidelines issued by the Central Bank of India concerning conflicts of interest for its employees. It could lead to decisions that are not objective, potentially jeopardizing the central bank's mandate to ensure financial stability and sound banking practices. Another incorrect approach would be to disclose the conflict but continue to participate in decisions, arguing that their professional judgment is unaffected. This is insufficient because it fails to address the perception of bias and the potential for undue influence, which can erode confidence in the central bank's impartiality. The regulatory framework often requires not just the absence of actual conflict, but also the avoidance of the appearance of conflict. Professional decision-making in such situations should follow a framework of transparency, integrity, and adherence to established policies. When a potential conflict of interest arises, the professional's first step should be to identify and assess the nature and extent of the conflict. This should be followed by immediate and full disclosure to the relevant authority or supervisor. Based on the assessment and disclosure, the professional should then take appropriate action, which typically involves recusal from any decision-making processes where the conflict exists. If unsure, seeking guidance from a compliance department or legal counsel is crucial. This systematic approach ensures that ethical standards are maintained and regulatory obligations are met, safeguarding both the individual's professional standing and the institution's reputation. Question 10. What factors determine the adequacy of the risk assessment framework for Central Bank of India's proposed new digital lending product, considering the Reserve Bank of India's guidelines on prudential risk management and digital lending? Option A. The projected revenue growth and market share expansion achievable through the digital lending product. Option B. The speed at which the digital lending product can be launched to capture market opportunities. Option C. The extent to which the assessment relies on historical performance data from traditional, non-digital lending portfolios. Option D. The comprehensiveness of the assessment in evaluating credit, operational, cybersecurity, compliance, market, and liquidity risks, aligned with RBI's prudential norms and digital lending guidelines. The correct answer is D. The comprehensiveness of the assessment in evaluating credit, operational, cybersecurity, compliance, market, and liquidity risks, aligned with RBI's prudential norms and digital lending guidelines. Explanation. This scenario is professionally challenging because it requires the risk assessment team at Central Bank of India to balance the imperative of financial stability with the need to support economic growth through lending. The challenge lies in accurately identifying and quantifying the diverse risks associated with a new digital lending product, ensuring that the assessment is not overly conservative to stifle innovation, nor too lenient to endanger the bank's financial health or depositors' funds. Adherence to the Reserve Bank of India's, RBI, guidelines on digital lending and risk management is paramount. The correct approach involves a comprehensive, multifaceted risk assessment that considers both quantitative and qualitative factors, aligning with RBI's prudential norms and guidelines for digital lending. This includes evaluating credit risk through robust underwriting and portfolio monitoring, operational risk by assessing the technological infrastructure, cybersecurity, and internal controls, and compliance risk by ensuring adherence to all relevant laws and regulations, including data privacy and consumer protection. Furthermore, It necessitates an assessment of market risk and liquidity risk, especially concerning the funding of these digital loans. This holistic view ensures that Central Bank of India can make informed decisions about the product's viability and risk mitigation strategies, thereby safeguarding its financial integrity and meeting regulatory expectations. An incorrect approach that focuses solely on the potential for increased revenue without a commensurate evaluation of the associated risks would be professionally unacceptable. This failure would stem from a disregard for RBI's emphasis on prudent risk management and could lead to significant financial losses if the loan portfolio deteriorates. Another incorrect approach that prioritizes speed of deployment over thoroughness of risk assessment would also be a significant ethical and regulatory failure. This haste could overlook critical vulnerabilities in the digital platform or underwriting processes, exposing the bank to operational and credit risks that are not adequately managed, potentially violating RBI's directives on robust risk management frameworks. A third incorrect approach that relies on historical data from traditional lending products without accounting for the unique risks of digital lending would be inadequate. Digital lending introduces new vectors of risk, such as sophisticated cyber threats, algorithmic bias, and rapid scalability issues, which require specific analytical tools and mitigation strategies not fully captured by traditional models. The professional decision-making process for similar situations should involve a structured risk assessment framework that is aligned with RBI's regulatory expectations. This framework should mandate the identification, measurement, monitoring, and control of all material risks. It requires cross-functional collaboration involving credit, operations, technology, compliance, and legal departments. Regular review and updating of risk assessments based on evolving market conditions and regulatory pronouncements are crucial. Furthermore, a strong ethical compass, emphasizing the protection of customer interests and the stability of the financial system, must guide all risk management decisions. Question 11. Stakeholder feedback indicates a potential operational risk within the new digital onboarding process at Central Bank of India, specifically concerning the verification of customer identity documents. While the feedback is currently anecdotal, it suggests a possibility of procedural gaps that could lead to compliance issues. What is the most appropriate immediate step for the risk management team to take? Option A. Initiate a preliminary risk assessment to understand the nature and potential impact of the reported issue, followed by formal documentation and escalation according to the Central Bank of India's risk management policy. Option B. Immediately halt the digital onboarding process and implement a manual verification system until a comprehensive review can be completed. Option C. Develop and deploy a new set of enhanced security protocols for the digital onboarding process based on the anecdotal feedback. Option D. Classify the feedback as low priority and monitor the situation without immediate action, as there is no quantifiable evidence of a significant risk yet. The correct answer is A. Initiate a preliminary risk assessment to understand the nature and potential impact of the reported issue, followed by formal documentation and escalation according to the Central Bank of India's risk management policy. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the need for timely risk mitigation with the imperative to adhere to the Central Bank of India's (CBI) established risk assessment frameworks and reporting protocols. Misinterpreting or bypassing these established procedures, even with good intentions, can lead to inaccurate risk profiles, ineffective controls, and potential regulatory noncompliance. The pressure to act quickly must be tempered by the requirement for thoroughness and adherence to the prescribed methodology. Correct approach analysis. The correct approach involves initiating an immediate, albeit preliminary, risk assessment based on the stakeholder feedback, followed by a formal, documented review and escalation according to the CBI's internal risk management guidelines. This ensures that the feedback is captured and addressed promptly while maintaining the integrity of the risk assessment process. The CBI's regulatory framework emphasizes a structured approach to risk identification, assessment, and mitigation, requiring that all significant risk events are formally documented and managed through established channels. This approach aligns with the principles of sound risk governance and regulatory compliance mandated by the CBI. Incorrect approaches analysis. Initiating a full-scale, ad hoc risk mitigation plan without a formal assessment and approval process is an incorrect approach. This bypasses the established risk assessment framework, potentially leading to misallocation of resources, ineffective controls, and a failure to accurately document and report the risk event as required by CBI guidelines. It demonstrates a lack of adherence to procedural integrity. Implementing mitigation strategies based solely on the preliminary feedback without further investigation or validation is also incorrect. This approach risks addressing the wrong issue or implementing solutions that are not proportionate to the actual risk, violating the principle of evidence-based decision-making inherent in robust risk management frameworks prescribed by the CBI. Ignoring the feedback due to a perceived lack of immediate quantifiable impact is fundamentally flawed. The CBI's guidelines require proactive identification and assessment of potential risks, regardless of their immediate quantifiable impact. Failure to acknowledge and assess stakeholder concerns can lead to the escalation of unaddressed risks, which is a direct contravention of regulatory expectations for a prudent financial institution. Professional reasoning. Professionals should adopt a systematic decision-making process that prioritizes adherence to regulatory frameworks. This involves 1. Acknowledging and documenting all stakeholder feedback immediately. 2. Conducting a preliminary assessment to understand the nature and potential severity of the reported risk. 3. Following established internal procedures for risk assessment, including consultation with relevant departments and escalation to appropriate management levels. 4. Implementing mitigation strategies only after a formal risk assessment and approval, ensuring alignment with the CBI's risk appetite and regulatory requirements. 5. Documenting all steps taken and decisions made for audit and compliance purposes. Question 12. The monitoring system demonstrates a consistent pattern of deviations in the risk assessment scores for a portfolio of loans managed by the Central Bank of India's Retail Lending Division, suggesting a potential underestimation of credit risk. Which of the following is the most appropriate immediate next step for the Risk Management Department? Option A. Instruct the Retail Lending Division to immediately halt all new loan disbursements until the issue is resolved. Option B. Initiate a comprehensive review of the loan portfolio's risk assessment methodology, cross-referencing with the Reserve Bank of India's prudential guidelines on credit risk management and internal audit reports. Option C. Recommend an immediate increase in provisioning for the affected loan portfolio to offset potential future losses. Option D. Escalate the findings to the Board of Directors for an urgent decision on portfolio restructuring. The correct answer is B. Initiate a comprehensive review of the loan portfolio's risk assessment methodology, cross-referencing with the Reserve Bank of India's prudential guidelines on credit risk management and internal audit reports. Explanation. This scenario presents a professional challenge because it requires the assessment of a critical risk management process within a financial institution, specifically the Central Bank of India, under its regulatory purview. The challenge lies in accurately identifying deviations from established risk assessment protocols and understanding the implications of such deviations under Indian banking regulations. A nuanced understanding of the Reserve Bank of India's (RBI) guidelines on risk management, internal controls, and operational risk is paramount. The monitoring system's output, while indicating a potential issue, necessitates a judgment call on the severity and the appropriate response, balancing efficiency with regulatory compliance and the bank's overall financial health. The correct approach involves a thorough, documented review of the identified anomalies against the bank's internal risk assessment policies and relevant RBI circulars. This approach is correct because it adheres to the principles of robust risk management and internal governance mandated by the RBI. Specifically, it aligns with the expectation that financial institutions maintain comprehensive risk assessment frameworks, conduct regular reviews, and implement corrective actions based on evidence. The RBI's emphasis on a proactive and systematic approach to risk management, as outlined in various master directions and circulars, necessitates such a detailed investigation to ensure that potential risks are identified, quantified, and mitigated effectively, thereby safeguarding the bank's assets and reputation. An incorrect approach that focuses solely on immediate cost reduction without a proper risk assessment would be professionally unacceptable. This failure stems from a disregard for regulatory mandates that require a comprehensive understanding of risk before implementing cost-saving measures. Such an approach could lead to the overlooking of significant operational or credit risks, potentially resulting in financial losses that far outweigh any short-term savings. It also violates the ethical obligation to act in the best interest of the bank and its stakeholders by prioritizing short-term gains over long-term stability and compliance. Another incorrect approach that involves escalating the issue without any preliminary analysis or data gathering would also be professionally unsound. This bypasses the fundamental responsibility of a risk management professional to conduct an initial assessment. It creates unnecessary alarm and consumes valuable resources at higher levels without providing them with sufficient context or actionable information. This demonstrates a lack of initiative and an abdication of responsibility, failing to uphold the professional standard of due diligence expected in risk management. The professional decision-making process for similar situations should involve a structured approach. First, understand the nature of the anomaly reported by the monitoring system. Second, consult relevant internal policies and external regulations, RBI guidelines, to determine the expected standard. Third, gather and analyze data to assess the extent and potential impact of the deviation. Fourth, document findings and proposed actions. Finally, communicate findings and recommendations to appropriate stakeholders, ensuring transparency and accountability. This systematic process ensures that decisions are informed, compliant, and aligned with the bank's risk appetite and regulatory obligations. Question 13. Operational review demonstrates that the customer onboarding process at Central Bank of India is experiencing significant delays, impacting customer satisfaction and potentially leading to lost business opportunities. The head of operations is keen to implement a new digital solution that promises to drastically reduce processing times. However, the proposed solution has not undergone a thorough review by the bank's compliance and risk management departments to ensure it aligns with the Reserve Bank of India's (RBI) guidelines on customer due diligence, data privacy, and cybersecurity. Which of the following approaches best addresses this situation while adhering to the regulatory framework and ethical standards expected of Central Bank of India employees? Option A. Halt the implementation of the new digital solution and initiate a comprehensive review involving compliance, risk management, and IT security teams to assess its adherence to all applicable RBI regulations and internal policies before any further action is taken. Option B. Proceed with a partial implementation of the digital solution in a limited branch to test its efficiency, while deferring the full regulatory compliance check until after the initial rollout. Option C. Request the head of operations to personally vouch for the solution's compliance, bypassing formal review processes to expedite the onboarding. Option D. Immediately approve and implement the new digital solution to expedite customer onboarding, assuming that a faster process inherently benefits the bank and its customers. The correct answer is D. Immediately approve and implement the new digital solution to expedite customer onboarding, assuming that a faster process inherently benefits the bank and its customers. Explanation. This scenario presents a professional challenge for a Central Bank of India employee because it requires balancing the need for efficiency with strict adherence to regulatory frameworks and ethical conduct. The employee must navigate potential conflicts between internal operational goals and external compliance requirements, ensuring that any process optimization does not inadvertently lead to non-compliance or compromise the integrity of the bank's operations. Careful judgment is required to identify solutions that are both effective and legally sound. The correct approach involves a comprehensive review of existing processes, identifying bottlenecks, and proposing improvements that align with the Reserve Bank of India (RBI) guidelines and banking regulations. This includes ensuring that any changes do not violate prudential norms, data privacy laws, or anti-money laundering (AML) regulations. The justification for this approach lies in the RBI's mandate to maintain financial stability and protect depositors, which necessitates robust and compliant operational processes. Adhering to these regulations ensures the Central Bank of India operates with integrity and maintains public trust. An incorrect approach that focuses solely on cost reduction without considering regulatory implications would be professionally unacceptable. This could lead to violations of RBI directives on customer service, data security, or reporting requirements, potentially resulting in penalties, reputational damage, and loss of customer confidence. Another incorrect approach that prioritizes speed over accuracy and compliance would similarly fail. This might involve shortcuts in customer verification processes, which could contravene Know Your Customer (KIC) norms and AML regulation, exposing the bank to significant risks. A third incorrect approach that involves implementing unapproved technology without proper risk assessment and regulatory clearance would also be flawed. This could introduce vulnerabilities in the bank's IT infrastructure, violating cybersecurity guidelines and data protection laws. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory landscape, including RBI circulars, master directions, and relevant acts. This should be followed by a detailed assessment of the current process, identifying areas for improvement. Proposed solutions must then be evaluated against regulatory requirements, ethical considerations, and potential risks. Collaboration with compliance and legal departments is crucial to ensure all proposed changes are fully compliant before implementation. Question 14. Operational review demonstrates that several customer onboarding processes at Central Bank of India are manual, time-consuming, and prone to human error, leading to delays and potential customer dissatisfaction. Considering the regulatory framework and guidelines applicable to the Central Bank of India, which of the following approaches to process optimization would be most appropriate? Option A. Implementing a phased automation of the customer onboarding process, starting with data verification and KYC checks, while ensuring robust validation against existing RBI guidelines and conducting thorough risk assessments for each automated step. Option B. Reducing the number of verification steps in the onboarding process to expedite customer acquisition, even if it means slightly deviating from some standard operating procedures. Option C. Outsourcing the entire customer onboarding function to a third-party vendor to leverage their expertise and reduce internal workload, without extensive due diligence on the vendor's compliance capabilities. Option D. Immediately replacing all manual steps with the latest available technology solutions to achieve maximum efficiency gains and cost savings. The correct answer is A. Implementing a phased automation of the customer onboarding process, starting with data verification and KYC checks, while ensuring robust validation against existing RBI guidelines and conducting thorough risk assessments for each automated step. Explanation. Scenario analysis. This scenario presents a professional challenge for a Central Bank of India employee tasked with optimizing processes within the bank. The challenge lies in balancing the need for efficiency and cost reduction with the imperative to maintain robust internal controls and adhere strictly to the regulatory framework governing Indian financial institutions. Any proposed process optimization must not inadvertently create new risks or violate existing guidelines set by the Reserve Bank of India, RBI, or other relevant Indian authorities. The employee must demonstrate a nuanced understanding of operational efficiency while prioritizing compliance and risk management. Correct approach analysis. The correct approach involves a systematic review of existing processes, identifying bottlenecks and inefficiencies, and then proposing solutions that are evaluated against their impact on compliance, risk, and operational effectiveness. This approach is correct because it aligns with the principles of sound banking practices mandated by the RBI. Specifically, the RBI's guidelines on internal control, risk management, and operational efficiency emphasize a holistic view where improvements must not compromise the bank's stability or regulatory standing. This method ensures that any changes are not only efficient but also sustainable and compliant, thereby safeguarding the bank's reputation and adherence to its legal obligations. Incorrect approach is analysis. Focusing solely on cost reduction without considering the impact on control mechanisms is an incorrect approach. This could lead to the erosion of internal controls, increasing the risk of fraud, errors, or non-compliance with RBI directives, which would be a significant regulatory failure. Implementing new technology without a thorough risk assessment and validation against existing regulatory requirements is also incorrect. This could introduce unforeseen vulnerabilities or operational disruptions that contravene RBI's prudential guidelines and cybersecurity mandates. Automating processes without adequate testing and validation of their compliance with data privacy laws and banking regulations is another incorrect approach. This risks data breaches or non-compliance with regulations like the Digital Personal Data Protection Act, 2023, leading to penalties and reputational damage. Professional reasoning. Professionals in a regulated environment like the Central Bank of India must adopt a risk-based and compliance-first mindset when considering process optimization. The decision-making process should involve 1. Understanding the current process and its objectives. 2. Identifying potential areas for improvement with a focus on efficiency and effectiveness. 3. Conducting a thorough impact assessment, specifically evaluating the implications for regulatory compliance, risk exposure, and data security. 4. Consulting relevant internal policies and external regulatory guidelines, e.g., RBI Circulars, Banking Regulation Act, 1949. 5. Piloting proposed changes in a controlled environment before full implementation. 6. Establishing clear metrics for success that include both efficiency gains and continued compliance. Question 15. The control framework reveals that the operational efficiency of the loan processing department at Central Bank of India has been declining, leading to increased turnaround times and customer dissatisfaction. To address this, the management is considering various strategies for process optimization. Which of the following strategies best aligns with the regulatory expectations for a financial institution operating under the Reserve Bank of India's oversight, ensuring both efficiency and robust control? Option A. Adopting a new, unproven technology solution for loan processing based on a single department head's recommendation, without a comprehensive risk assessment or pilot testing. Option B. Expediting the loan approval process by significantly reducing the number of mandatory checks and balances, with the assumption that increased volume will compensate for any minor control lapses. Option C. Outsourcing the entire loan processing function to a third-party vendor, without establishing clear performance metrics, service level agreements, or ongoing oversight mechanisms. Option D. Implementing a phased approach to automate key stages of loan origination and approval, integrating automated checks and balances, and conducting rigorous user acceptance testing to ensure control integrity throughout the optimization process. The correct answer is D. Implementing a phased approach to automate key stages of loan origination and approval, integrating automated checks and balances, and conducting rigorous user acceptance testing to ensure control integrity throughout the optimization process. Explanation. This scenario presents a professional challenge because it requires balancing the need for operational efficiency with the imperative of maintaining robust internal controls, as mandated by the regulatory framework governing the Central Bank of India. The pressure to streamline processes, while seemingly beneficial for productivity, can inadvertently create vulnerabilities if not managed with a deep understanding of compliance requirements and risk management principles. Careful judgment is required to identify and implement process improvements that do not compromise the integrity of financial operations or violate regulatory directives. The correct approach involves a systematic review and enhancement of existing workflows, focusing on identifying bottlenecks and redundancies that can be addressed through technology adoption and procedural refinement, while simultaneously embedding control points and audit trails. This approach is right because it aligns with the principles of sound governance and risk management expected of financial institutions under the purview of the Reserve Bank of India, RBI. Specifically, it supports the RBI's emphasis on operational efficiency, risk mitigation, and the establishment of effective internal control systems as outlined in various circulars and guidelines pertaining to internal audit, risk management, and IT governance. By proactively integrating controls into optimized processes, the bank ensures that efficiency gains do not come at the expense of compliance or security. An incorrect approach that focuses solely on cost reduction by eliminating established control mechanisms would be professionally unacceptable. This failure stems from a disregard for regulatory mandates that require specific controls to prevent fraud, errors, and operational disruptions. Such an approach would likely violate RBI guidelines on internal controls and financial reporting integrity, exposing the bank to significant reputational and financial risks. Another incorrect approach that prioritizes speed of implementation over thorough risk assessment and impact analysis would also be professionally flawed. This failure lies in bypassing due diligence, which is critical for understanding how process changes might affect compliance with existing regulations or introduce new risks. The RBI expects a measured and informed approach to change management, ensuring that all potential implications are considered before implementation. A further incorrect approach that relies on anecdotal evidence or the opinions of a few individuals without a structured analysis of process performance and control effectiveness would be professionally unsound. This method lacks the rigor and objectivity required for effective process optimization in a regulated environment. It fails to provide a data-driven basis for decision-making and may overlook critical control deficiencies or opportunities for improvement that a systematic review would uncover. The professional decision-making process for similar situations should involve a structured approach that begins with a comprehensive understanding of the current process, its objectives, and its associated risks. This should be followed by an analysis of potential improvements, considering both efficiency gains and the impact on internal controls and regulatory compliance. Engaging relevant stakeholders, conducting thorough risk assessments, and obtaining necessary approvals before implementation are crucial steps. Finally, continuous monitoring and evaluation of the optimized process are essential to ensure ongoing effectiveness and compliance. Question 16. The assessment process reveals that a candidate for a role at the Central Bank of India is asked to propose process optimization strategies for a hypothetical retail banking division. The candidate is aware that the Central Bank of India places significant emphasis on customer service efficiency and regulatory adherence. Which of the following approaches best demonstrates an understanding of these priorities within the Indian regulatory framework? Option A. Implementing a new loan approval process that significantly reduces the time for sanctioning, but bypasses certain mandatory verification steps outlined by the Reserve Bank of India. Option B. Proposing a system that automates customer onboarding by collecting minimal personal data upfront, with a clear plan for obtaining further consent for data usage as per Indian data protection laws and RBI guidelines. Option C. Recommending the outsourcing of customer complaint resolution to a third-party vendor without establishing clear service-level agreements, or ensuring compliance with Indian banking regulations for outsourced activities. Option D. Suggesting the immediate digitization of all customer records without a comprehensive data security audit, citing the need for rapid access to information. The correct answer is B. Proposing a system that automates customer onboarding by collecting minimal personal data upfront, with a clear plan for obtaining further consent for data usage as per Indian data protection laws and RBI guidelines. Explanation. This scenario presents a professional challenge because the Central Bank of India (CBI) hiring assessment test is designed to evaluate candidates' understanding of regulatory compliance and ethical conduct within the Indian financial sector. The pressure to perform well in such a high-stakes assessment can lead candidates to consider shortcuts or misinterpretations of guidelines. Careful judgment is required to ensure that responses are not only accurate, but also align with the specific regulatory framework governing the Indian banking industry, as mandated by the CBI. The correct approach involves prioritizing adherence to the stated objectives of the assessment and the specific guidelines provided by the Central Bank of India. This means focusing on process optimization as a means to enhance efficiency and effectiveness within the bank's operations, strictly within the bounds of Indian banking regulations and the CBI's assessment instructions. This approach is professionally sound because it demonstrates a commitment to regulatory compliance and a thorough understanding of the assessment's intent. It reflects an ability to apply theoretical knowledge of process optimization to practical banking scenarios while respecting the legal and ethical framework of the Indian financial system, as expected by the Central Bank of India. An incorrect approach that focuses on implementing process changes without considering their potential impact on customer data privacy, as defined by Indian data protection laws and RBI guidelines, would be professionally unacceptable. This failure stems from a disregard for regulatory mandates concerning data security and confidentiality, which are paramount in the banking sector. Another incorrect approach that involves prioritizing speed of implementation over thorough risk assessment, potentially leading to operational vulnerabilities or non-compliance with prudential norms set by the Reserve Bank of India, is also professionally flawed. This demonstrates a lack of due diligence and an insufficient understanding of the interconnectedness of process efficiency and regulatory risk management. Professionals should employ a decision-making framework that begins with a clear understanding of the assessment's objectives and the applicable regulatory environment. This involves dissecting the problem, identifying potential solutions, and then rigorously evaluating each solution against the specific requirements of Indian banking laws, RBI circulars, and the assessment's instructions. A critical step is to consider the ethical implications and potential risks associated with each approach, ensuring that any proposed optimization aligns with the principles of sound banking practices and regulatory compliance as enforced by the Central Bank of India. Question 17. Cost-benefit analysis shows that implementing a new AI-powered customer service chatbot for initial query resolution could significantly reduce operational costs for the Central Bank of India's retail banking division. However, the proposed system's data handling protocols are still under internal review, and there are concerns about its ability to fully comply with the Reserve Bank of India's evolving data privacy and customer grievance redressal guidelines, which approach best balances cost efficiency with regulatory adherence. Option A. Implement the AI chatbot for all customer interactions, assuming that general data protection principles will suffice and that the RBI's specific guidelines are flexible enough to accommodate the new technology. Option B. Deploy the AI chatbot immediately to realize cost savings, with a plan to address any potential compliance issues retrospectively as they arise. Option C. Defer the implementation of the AI chatbot indefinitely until a completely foolproof and universally compliant system is developed, prioritizing absolute regulatory certainty over immediate cost benefits. Option D. Conduct a comprehensive pilot program of the AI chatbot in a limited segment of the retail banking division, focusing on non-sensitive queries, while simultaneously finalizing its compliance framework with explicit RBI guidelines and seeking pre-implementation feedback. The correct answer is B. Deploy the AI chatbot immediately to realize cost savings, with a plan to address any potential compliance issues retrospectively as they arise. Explanation. This scenario is professionally challenging because it requires balancing operational efficiency gains with the imperative to maintain robust internal controls and compliance with banking regulations, specifically those overseen by the Reserve Bank of India, RBI. The pressure to reduce costs must not compromise the integrity of financial reporting or the security of customer data, both critical areas of regulatory focus for the Central Bank of India. Careful judgment is required to identify process improvements that are both beneficial and compliant. The correct approach involves a phased implementation of technology-driven process optimization, prioritizing areas with the highest risk and regulatory impact. This strategy ensures that critical functions like KYC, Know Your Customer, verification, transaction monitoring, and data security are not inadvertently weakened during the transition. By conducting thorough pilot testing and seeking regulatory guidance where necessary, the bank demonstrates a commitment to responsible innovation and adherence to RBI guidelines on operational risk management and digital transformation. This proactive stance minimizes the likelihood of compliance breaches and reputational damage. An incorrect approach that focuses solely on immediate cost reduction without considering the regulatory implications would be professionally unacceptable. For instance, automating customer onboarding without ensuring the new system fully meets RBI's stringent KYC and AML, anti-money laundering, norms would expose the bank to significant penalties and operational risks. Similarly, outsourcing critical IT infrastructure without rigorous vendor due diligence and adherence to RBI's guidelines on outsourcing of services would create vulnerabilities and potential data breaches, violating the principle of maintaining adequate control over outsourced activities. Another incorrect approach might be to implement a new system without adequate staff training, leading to errors and non-compliance, which would be a failure in operational risk management. Professionals should employ a decision-making framework that integrates regulatory compliance, risk assessment, and strategic objectives. This involves understanding the specific RBI directives relevant to process optimization, such as those pertaining to digital banking, operational risk, and data privacy. A thorough risk-reward assessment for each proposed optimization, considering potential compliance gaps and mitigation strategies, is crucial. Engaging with compliance and risk management departments early in the process and seeking clarification from regulatory bodies when in doubt are essential steps in ensuring that process improvements are both effective and compliant. Question 18. Operational review demonstrates that the customer onboarding process at Central Bank of India is experiencing significant delays, leading to customer dissatisfaction and potential loss of business. To address this, A proposal has been made to streamline the process by digitizing all document verification and reducing the number of internal checkpoints. Which of the following approaches best aligns with the Central Bank of India's commitment to operational excellence and regulatory compliance? Option A. Introduce a new, proprietary software for document management that bypasses existing data security protocols to speed up data entry, pending a later review by the IT department. Option B. Implement a fully digitized customer onboarding system, incorporating advanced AI for document verification and reducing internal checkpoints by 50% after a thorough risk assessment and pilot testing in a single branch. Option C. Focus solely on reducing the number of physical documents required, without significant changes to the digital verification or internal approval workflows, to minimize initial implementation costs. Option D. Immediately deploy a new, less stringent digital verification system across all branches to expedite onboarding, with a plan to address any compliance gaps retrospectively. Correct answer is B. Implement a fully digitized customer onboarding system, incorporating advanced AI for document verification and reducing internal checkpoints by 50% after a thorough risk assessment and pilot testing in a single branch. Explanation. This scenario presents a professional challenge for a Central Bank of India employee due to the inherent responsibility of ensuring the integrity and efficiency of banking operations, particularly concerning process optimization. The challenge lies in balancing the pursuit of efficiency with the absolute necessity of adhering to the regulatory framework, laws, and guidelines set forth by the Reserve Bank of India, RBI, and relevant Indian legislation. Any proposed optimization must not compromise customer data security, regulatory compliance, or the stability of the financial system. Careful judgment is required to identify solutions that are both innovative and compliant. The correct approach involves a thorough assessment of existing processes, identification of bottlenecks, and the development of solutions that enhance efficiency while strictly adhering to the RBI's guidelines on operational risk management. Data privacy. As per the Digital Personal Data Protection Act, 2023, if applicable to the specific process, and customer service standards, this approach is correct because it prioritizes regulatory compliance and ethical conduct, which are paramount in the banking sector. It ensures that any changes implemented are not only beneficial for operational efficiency, but also legally sound and do not expose the Central Bank of India or its customers to undue risk. The focus on a phased implementation with pilot testing and stakeholder consultation further mitigates risks and ensures smooth adoption. An incorrect approach that focuses solely on cost reduction without considering the impact on data security or regulatory compliance would be professionally unacceptable. This failure stems from a disregard for the stringent data protection laws and RBI directives that mandate robust security measures. Another incorrect approach that bypasses established internal approval processes and regulatory checks for the sake of speed would violate principles of good governance and internal control, potentially leading to operational failures and reputational damage. Furthermore, an approach that overlooks the need for employee training and change management, assuming that new technology will be self-explanatory, would be flawed. This neglects the human element of process change and can lead to errors, resistance, and a failure to achieve the intended efficiency gains, potentially contravening guidelines on workforce management and operational resilience. Professionals in such situations should employ a decision-making framework that begins with a comprehensive understanding of the current process and its objectives. This should be followed by an in-depth review of all applicable RBI regulations, Indian banking laws, and internal policies. Potential solutions should then be evaluated against these regulatory requirements, focusing on their impact on efficiency, risk, compliance, and customer experience. A risk-based approach, involving pilot testing and stakeholder feedback, is crucial before full-scale implementation. Ethical considerations, such as data privacy and fairness, must be integrated into every stage of the decision-making process. Question 19. System analysis indicates that Central Bank of India is exploring ways to streamline its loan processing workflow to reduce turnaround times. A proposal suggests automating several manual data entry points and reducing the number of internal review stages, which approach best balances efficiency gains with regulatory compliance. Option A. Focus solely on the technological feasibility of automation, deferring any regulatory compliance checks until after the system is fully operational. Option B. Implement the proposed automation and review stage reduction immediately to capture efficiency benefits, addressing any regulatory concerns that arise post-implementation. Option C. Conduct a detailed review of the proposed changes against the Banking Regulation Act, 1949, and all relevant RBI circulars and master directions, focusing on KYC, credit appraisal norms, and data security before any implementation. Option D. Prioritize the reduction of review stages to cut costs, assuming that automation will inherently comply with existing regulations without specific verification. The correct answer is B. Implement the proposed automation and review stage reduction immediately to capture efficiency benefits, addressing any regulatory concerns that arise post-implementation. Explanation. Scenario analysis. This scenario presents a common challenge in banking operations where efficiency improvements are sought, but the implementation must strictly adhere to the regulatory framework governing the Central Bank of India. The professional challenge lies in balancing the pursuit of process optimization with the imperative of compliance, ensuring that any changes do not inadvertently violate existing banking laws, Reserve Bank of India, RBI, guidelines, or internal policies designed to safeguard financial integrity and customer trust. Misjudging the regulatory landscape can lead to significant penalties, reputational damage, and operational disruptions. Correct approach analysis. The correct approach involves a thorough review of existing processes against the backdrop of the Banking Regulation Act, 1949, and relevant RBI circulars and master directions. This includes assessing how proposed optimizations align with prudential norms, customer service standards mandated by the RBI, and data privacy regulations. For instance, if a process involves customer data, the optimization must ensure compliance with the RBI's guidelines on data localization, security, and customer consent. The focus on identifying and mitigating regulatory risks before implementation is paramount. This proactive stance ensures that process improvements enhance efficiency without compromising the bank's legal and ethical obligations, thereby upholding the integrity of Central Bank of India's operations. Incorrect approaches analysis. Implementing changes based solely on perceived efficiency gains without a comprehensive regulatory impact assessment is a significant failure. This could involve automating a customer onboarding process that bypasses mandatory Know Your Customer (KYC) verification steps as stipulated by the Prevention of Money Laundering Act, 2002, and RBI guidelines. Another failure would be to adopt a new technology for transaction processing that does not meet the cybersecurity standards prescribed by the RBI, potentially exposing the bank to financial fraud and data breaches. Prioritizing cost reduction over regulatory adherence, such as streamlining audit trails to save time, but losing essential data required for regulatory reporting, also constitutes a critical ethical and regulatory lapse. Professional reasoning. Professionals at Central Bank of India should adopt a structured decision-making process that begins with understanding the objective process optimization. This must be immediately followed by a comprehensive regulatory impact assessment, consulting relevant RBI directives, the Banking Regulation Act, and internal compliance departments. Potential risks should be identified and quantified, and mitigation strategies developed. Implementation should only proceed after obtaining necessary approvals and ensuring all compliance requirements are met. Continuous monitoring post-implementation is also crucial to ensure ongoing adherence to regulations. Question 20. Operational review demonstrates that the customer onboarding process at Central Bank of India is experiencing significant delays, leading to a backlog of new account applications. A junior officer proposes implementing a new digital verification system that bypasses some of the existing manual checks, citing anecdotal evidence of faster processing times in other departments. However, this proposal has not been formally assessed for compliance with RBI's Know Your Customer (KYC) norms or data security protocols. Which of the following approaches best aligns with professional conduct and regulatory requirements for Central Bank of India? Option A. Implement the digital verification system on a trial basis in a single branch, without a formal compliance review to gauge its effectiveness. Option B. Conduct a thorough, documented assessment of the proposed digital verification system, ensuring it meets all RBI KYC guidelines and data protection regulations before considering pilot implementation. Option C. Immediately implement the proposed digital verification system across all branches to expedite the onboarding process based on the junior officer's recommendation and observed efficiency in other departments. Option D. Focus solely on increasing the number of staff involved in manual verification to clear the backlog, without exploring alternative technological solutions. The correct answer is B. Conduct a thorough, documented assessment of the proposed digital verification system, ensuring it meets all RBI KYC guidelines and data protection regulations before considering pilot implementation. Explanation. This scenario presents a professional challenge for a Central Bank of India employee because it requires balancing operational efficiency with strict adherence to regulatory mandates and ethical conduct. The pressure to improve processes must not override the fundamental principles of data integrity, customer confidentiality, and compliance with Reserve Bank of India (RBI) guidelines. Careful judgment is required to identify solutions that are both effective and compliant. The correct approach involves a systematic, data-driven review of existing processes, identifying bottlenecks, and proposing solutions that are validated against current RBI regulations and internal bank policies. This approach ensures that any proposed changes are not only efficient, but also legally sound and ethically responsible, safeguarding customer data and maintaining the bank's reputation. It prioritizes a thorough understanding of the current state before implementing changes, minimizing risks of non-compliance or unintended negative consequences. An incorrect approach that bypasses formal validation and relies on anecdotal evidence or unverified assumptions poses significant regulatory and ethical risks. This could lead to the implementation of processes that violate data privacy norms mandated by the RBI, such as the Information Technology (IT) Act 2000 and related regulations concerning data handling and security. Furthermore, implementing changes without proper risk assessment or stakeholder consultation could result in operational disruptions, customer dissatisfaction, and potential reputational damage, all of which are contrary to the ethical obligations of a banking professional. Another incorrect approach that focuses solely on cost reduction without considering the impact on service quality or regulatory compliance would also be professionally unacceptable. This could lead to a decline in customer service standards or inadvertently create loopholes that compromise security, violating the bank's duty of care and regulatory obligations. Professionals should employ a decision-making framework that begins with a clear understanding of the problem and its potential impact. This involves consulting relevant RBI circulars, internal policies, and seeking guidance from compliance and risk management departments. Solutions should be evaluated not only for efficiency, but also for their adherence to legal and ethical standards, customer impact, and long-term sustainability. A phased implementation with pilot testing and continuous monitoring is crucial to ensure successful and compliant process optimization.